Two people, same salary, same $50,000 in savings, same age, same city. John buys a rental property. Stephen puts the same money into index funds. Both of them are convinced they made the right call. 20 years from now, we'll see who was right. But fair warning up front, the answer isn't what you'd expect. Subscribe so you don't miss what's coming next. Let's go. Day 1. Two very different feelings. John takes his $50,000 and uses it as a down payment on a $250,000 house. 30-year mortgage at 7%. Monthly payment, $1,330. He finds a tenant willing to pay $1,800 a month. The difference, $470 a month. On paper, John feels like a genius. He has keys. He has a tenant. He has a story to tell at dinner parties. He drives past the house on his way to work and thinks, I own that. Stephen takes the same $50,000 and puts it into a broad market index fund, sets up an automatic contribution of $300 a month, gets a confirmation email. Coworkers ask John about the property. Nobody asks Stephen anything. On the surface, John is winning by a mile, but feelings and math are two very different things. The numbers everyone sees, and the numbers nobody counts. $470 a month. That's the number you see on YouTube thumbnails. That's the number people talk about at barbecues. That's the number the passive income story is built on. But that's just the difference between the rent and the mortgage. Before you spend a single dollar on anything else, here's what gets subtracted after. Property taxes, about $3,000 a year. Insurance, $1,500. In the first 3 years, John has already replaced the water heater for $1,200, fixed a leaking roof for $2,800, and dealt with 1 month of vacancy between tenants. $1,800 in lost rent plus $600 to clean and relist. On top of that, John manages the property himself to save money. That means calls at 10 p.m., showings on weekends, and coordinating repairs on his lunch break. Real cash flow after 3 years, somewhere between $2,000 and $4,000. Not the $16,920 that looked so good on paper. Stephen, in that same time, 0 calls, 0 repairs. Portfolio has grown to about $76,000. The question that's missing from the original math, how much is your time worth? That's the question nobody asks when they calculate real estate returns. But it changes everything. John spends an average of around 200 hours a year managing the property. Showings, coordinating repairs, calls, paperwork, dealing with tenant situations. If his time is worth $25 an hour, that's $5,000 a year in hidden costs that don't show up in any return calculation. If it's $50 an hour, that's $10,000 a year. Over 20 years, that's $100,000 to $200,000 worth of time that doesn't get counted. Stephen spent about 20 minutes a year on his investments. Everything else was his. This doesn't mean real estate is a bad investment. It means the real return on real estate has to include your time. And most calculations don't. Year 10. The surprising tie. By year 10, something unexpected happens. John, the house is worth $335,000 to $350,000. Remaining mortgage balance around $166,000. Equity $170,000 to $184,000. Plus an additional $20,000 to $35,000 in out-of-pocket costs beyond the original down payment over 10 years. Stephen, portfolio sitting at $165,000 to $180,000. Total invested, $86,000. That's the $50,000 up front plus $36,000 in monthly contributions. Everything above that is pure growth. zero additional costs. In terms of total wealth, they're almost equal. John might be slightly ahead thanks to leverage, but John also spent thousands of hours managing the property, has all his capital concentrated in one asset in one zip code, and still carries $166,000 in debt. Stephen is diversified across thousands of companies, no debt, and hasn't lost a single weekend. What real estate has that stocks don't? This is the fair block. Real estate has real advantages that stocks simply can't match. Leverage. John used $50,000 to control a $250,000 asset. 5-to-1. When the value goes up, the gain is calculated on $250,000, not on $50,000. Stocks don't work that way. This is the main reason real estate has created more millionaires than the stock market in many studies. House hacking? You buy a property with multiple units, live in one, rent out the others. The tenants essentially pay your mortgage. You build equity while living nearly for free. That's something index funds simply cannot do. There's also real monthly cash flow from a well-run rental, tax advantages like depreciation and mortgage interest deductions, and the ability to roll profits into a new property without paying capital gains taxes. These are real tools that stock investors don't have access to. If you know how to use these advantages, real estate can significantly outperform stocks. The key phrase is, if you know how. The risks of stocks that nobody likes to talk about. Fair block on stocks. Talking only about the upside of investing is the same mistake as talking only about rental income and ignoring the expenses. Volatility is genuinely painful. In 2008, the market dropped about 37%. In March 2020, it fell 34% in a single month. If Stephen has $150,000 in his portfolio and watches it become $95,000 in a few weeks, that's not just a number on a screen. That's a real gut punch. And the data is clear. Most retail investors sell during crashes and buy back in after the recovery. They lock in losses at exactly the wrong moment. Beyond that, stocks don't send you a monthly check you can spend right now. There's no leverage, no control over what the investment produces. These are real limitations, and pretending otherwise doesn't help anyone. Year 20. The final math. 20 years in, the full picture becomes clear. John, the house is worth $450,000 to $500,000. Mortgage is nearly paid off. Equity somewhere between $400,000 and $500,000. Net profit from rent over 20 years after all real costs, $40,000 to $80,000, plus the appreciation in home value. Stephen, portfolio at $420,000 to $460,000. Total contributed over 20 years, $122,000. The other $300,000 plus is pure compounding. No debt, no tenants, no 2 a.m. calls about a broken pipe. In terms of total net worth, roughly the same. Both somewhere in the $400,000 to $500,000 range. But here's the detail that shifts the math in Stephen's favor. If he increased his monthly contribution from $300 to $500, the portfolio grows to $550,000 to $600,000. One small adjustment. No extra work. For John to increase his investment, he'd need to buy a second property, take on another mortgage, and double his workload. Who each option is right for. There's no universal right answer. There's a right answer for your situation. Real estate wins if you have free time and you're willing to spend it managing a property. If you live in a city where rent is high relative to purchase price. If you're willing to treat it like a business, not passive income. If you understand leverage and its risks. Stocks win if your life is already demanding and free time is limited. If you're just starting out and don't have $50,000 for a down payment, but can set aside $300 to $500 a month. If you want diversification without concentrating everything in one asset. If you value liquidity, the ability to access your money at any time without selling a house. Both can work together if you already have a solid financial foundation. Emergency fund covered. No high-interest debt. In that case, stocks are the foundation, and real estate is the next step, once you have the capital and the time to do it right. The one mistake both of them make. John only looks at the rent, $1,800 a month, and doesn't count the real costs. He makes decisions based on the number that looks good on paper, not the one that's actually left after everything. Stephen sells in a panic when the market drops 30%, then waits for things to stabilize and buys back in at a higher price than he sold. Both mistakes destroy returns, and both happen for the same reason: emotions instead of a system. John needs a system that accounts for all real costs, including his time. Stephen needs a system that prevents him from making decisions based on fear. The system matters more than the choice between real estate and stocks. So who won, John or Stephen? Real estate or stocks? It depends on who you are. If you're willing to treat real estate like a business, count every cost including your time, manage tenants well, keep reserves for repairs, real estate can win, especially with leverage and a strong rental market. If you want to build wealth without 2 a.m. phone calls, without concentrating all your capital in one asset, without 30 years of debt, index funds win on quality of life, even when the final numbers are close. The winner isn't real estate, and it isn't stocks. The winner is whoever asks the right question, not what's better in general, but what's better for my situation. And the only way to answer that is to count everything, not just the profit, everything, including your time. Leave a like if this was useful, and drop a comment. Are you team real estate or team stocks? And why?